So it's 2026, and right now we have a new Fed chairman, Kevin Warsh, who is taking the place of Jerome Powell. And a lot of people are trying to guess what's going to be the future, because obviously the Fed chairman is one of the most important person that has the higher impact on your investments whatsoever, whether they are from US or outside. So I want to talk about that a little bit, but first a little bit of context. A lot of people are worried about overvalued stocks right now because it seems like the overall market is overvalued. I've covered this in the last video I posted. So basically the market is kind of built around a cycle of usually 20 years of growth, and generally speaking, outside of the US, we call that phase a US exceptionalism phase. So that's just a phase where the US stock market clearly overperformed the average of every stock market, which is generally 8% because it's a production rate increase every year on average. And there's also, after that 20 to 25 year period of time, a 10 years period of time called usually the last decade, when the US stock market really underperformed the overall stock markets and the rest of the world usually clearly outperform it. Now, to understand a little bit more what could end this phase of US exceptionalism, there's generally speaking one signal and two triggers. So the first signal is an overvalued market. It has always been the case. Then considering the trigger, first a big rise in commodities prices. Considering gold for the last 4 years has tripled, we have one of our trigger. And the second will be a really structural weak dollar. So a lot of people maybe thought that the trigger happened last year with Trump tariffs that made the dollar collapse. But actually it's not really what we wanted to see, what could actually have an impact on the stock market this way to actually end the US exceptionalism. This is a way more structural bias that can really create a weak dollar, just like we've seen a weak yen for the past decade. And so when you think about it, it kind of makes sense that the weak dollar would be kind of the trigger. Because what if, for example, over a 10-year period, you think you can make 200% on the stock market of the US and also 200% on the stock market of, for example, Japan? Well, in the scenario where I tell you, the dollar is going to weaken against the yen, it seems like investing in Japanese companies makes more sense, because yes, you're going to make 100%, it seems 200%, it's going to seem like it's the same performance, but because your dollar will be weakened and the yen will rise in purchase power, in value, comparing those, it seems like actually your performance are going to be 200% for an American, but could be higher if you would have invested in Japanese stocks because they require you to hold yen. So that's just a mechanism that you have to understand to really understand that logic. It usually works better like that when the currency is clearly appreciating. That's what you can see, for example, with a lot of stocks in certain countries that were saved somewhat by, for example, Javier Milei in Argentina. In this country, a simple idea that their currency is going to stop falling created a massive rebound of the currency, and a lot of people thought that stock market is really skyrocketing in Argentina because of him. So yes, there were also investors, but that's also because of a lot of people that stopped shorting the Argentinian dollar. I think it's an Argentinian dollar, I'm not even sure. Okay, so now back to Kevin Warsh. Since he is now the new Fed chairman, what can we expect from him? Well, he was pretty clear about it. He's going to use a different type of forward guidance, which is really related to AI. He really thinks that AI will create a more fragile job market, and it will also result in lower inflation. So because of that, he thinks we're going to be in an environment that is perfectly suited for lower interest rates. And typically, usually lower interest rates are a thing that has a huge impact on the currency. That has somewhat proven over the long term that it really weakens the currency. And another little thing is also about the spreadsheet, the balance sheet, sorry. He really thinks the Federal Reserve is playing a too much role in today's economy, and he wants to reduce the balance sheet. And usually, reducing the balance sheet alone already lower inflation and then allow to lower interest rates. Now then, a lot of people will ask themselves, with that situation, knowing that the stock market is going to perform somewhat bad over the longer run, I'm not saying it's going to be tomorrow, okay? Usually, as I said, it's a phase of about 20 years. we can still be surprised with a shorter phase of maybe only 18 years. So basically, where could you put your money in that kind of situation? Well, obviously, the really overvalued sectors are really not something you want to invest in right now. For example, right now in finance, a lot of people talk about the energy sector, saying that it's very underpriced. And considering that we just need more and more energy as times go on, and especially electricity, because we just started to use more and more electricity as internet coming, and as internet was just evolving and being such a big thing. And right now with AI, we just know that, okay, in the 10, 15 next years, knowing that AI really boosts the number of query that we do with Google and with every kind of website, we're gonna use way more electricity in the future. So this is clearly a great investment right now that most people are talking about in the financial market, because it's one, undervalued, and second, high potential reward. Now, let's say you want to invest outside of the US. Generally speaking, there's different places you would want to invest. For example, a lot of people tend to invest in Australia and New Zealand. It makes sense if you find a good business, a good deal. Then I could think also about Europe. Right now, the overall European stock market is really undervalued, and we can clearly see a new trend in Europe of right-wing party being elected. So it's generally something that really helps the stock market over the longer run. Now, maybe I'm gonna talk about it, but it's not a so sure opportunity, because right now right-wing party are just somewhat right-wing socialists. So it's just less worse. It's not actually better, but it still could help the stock market overall. And to be a little bit more accurate, we have certain countries that have risen a lot and have had great earnings. For example, Poland. Poland is one of the greatest countries for now. It has huge growth, and clearly it will be an investment I would avoid to be too much exposed at, because it has risen so much and because everything is just going so great. It's generally in very, very good times that a very minor inconvenience can reverse the market. Also, I could think about Italy with Giorgia Meloni, who really helped the country and really reduced the unsafety index. So clearly, a lot of good things are probably going to happen in Europe in most countries. You just have to look for cases, for countries and the stocks, just to dig that up, the information, and be sure about your investments. Now in Asia, obviously a lot of people are going to be interested, because we have China and also stocks from Taiwan, which can be considered like stocks from China too, depending on your perspective and your political agenda. But yeah, both stock markets are really considered interesting. I would just say that, usually speaking, because Chinese people are manipulating their currency to lower it, it can have bad effects on US investors that would want to invest on the Chinese stock market. But since 2024, they've really started a huge phase of stimulus, and inflation is really, really low, so they really have a lot of margin. So typically that would be a great investment. Obviously, we have also India. A lot of people don't talk about it, but India is a great investment too right now. It has just grown a lot for the last decade. And with tariffs, surprisingly, but because tariffs made Chinese people look more expensive, right now a lot of companies are going to India to start to build whatever they believe they're gonna sell in other markets. Because just labor is just so cheap in India right now compared to other countries. And let's not forget that Indians are 1 billion people in their country. So being on that country is really bringing you a lot of labor just on one single time. Because for example, yes, Vietnamese Vietnamese labor are also very cheap, but Vietnam country is harder to penetrate and smaller and has also smaller amounts of people. So potential is just potential is just lower for companies. Now, Latin America is really a particular case, because they've been very, very socialist, and that has obviously not worked so well, and they kind of have a hard time to learn the lesson. But right now we're seeing a new wind of right-wing party being elected, and there's just hope that maybe things are going to get better. It seems like with Venezuela, people were pretty glad about it. Brazil has a cyclical economy that really benefits from a huge commodity prices rise. Obviously, we had in 2022 Javier Milei in Argentina, obviously also helped a lot. He really reduced inflation. And I don't think in 4 years he has the time to do anything. But if he could have second mandates, he could totally reverse the curve. Now, also, there's Chile, for example, because they have lithium and copper. So again, they are very cyclical. And when there is a big commodity price rise, usually they will benefit from it. Now, there's also obviously Colombia, which is a very big country, but I'd say that Colombia would be a great deal depending on the next election. So we shall see. And now, certain people will probably ask about Africa. I really don't know about Africa, to be honest. If I would just have one recommendation, just don't buy anything that is under the Sahara Desert. But on the north, why not? I don't really know these countries, how they are working right now. But yeah, I don't have my money on it, so obviously that's not something I would recommend. As you know, I'm not a financial advisor, so whatever I said, it's just a share of knowledge. Okay, do not use it as a guarantee. Do your own research before you invest your money in any kind of company.